Yeah, welcome again to my channel. This is Xander FST and I am Oya Benjamin. In this channel, we provide you with videos that help you maximize profit and minimize losses. If you are new to our channel, you are welcome. And to those that are already subscribed, thank you for your trust and thank you for your support. That we are where we are today is because of your support, and we appreciate every one of you. I want you to understand that price movements create a lot of patterns that determines the institutional order flows in the market. In this video, we're going to be looking at these patterns created by price movement, and we're going to be looking at what to expect from them whenever we spot them play out in the market. Stay tuned and don't go anywhere. Now, let's look at them one after the other. Now, we're going to start from number one, which is the breaker block. Now, what is a breaker block? When another block is not respected, it gives you a pattern called a breaker block. Now, when you look at it at this chart here, you notice that now this is the last bearish candle here. Now, it is expected that as the market move, it should come down here, then before continuing the trend. But if you look at this case now, you notice that the market did not respect that move, okay? Rather, this order block was broken by this bearish candle. Now, once an order block is broken, it gives you another pattern called a breaker block. I want you to know that a breaker block initiates a market structure shift in the market. Now, once a breaker block occurs, it gives you a change in the price movement. Now, if the market was in an uptrend before and the order block fails to hold the market in an uptrend, automatically there will be a reversal to a bearish movement. Now, if you look at this market, you notice that it has been in an uptrend, okay? It has been in an uptrend. Now, this happens to be the last bearish candle before this movement, okay? Now, it is expected that this order block should be able to hold this market to pull it backward. Now, as the market has come down here, it is expected that it should mitigate this order block and continue the upward movement. But if you look at this case here, you discover that the market, the order block could not hold the market. Now, it was broken here. Are you there? Now, because it has been broken, a breaker block has occurred. Now, what are we expecting? A reversal in the price movement. That is why you see the market came down, retested and balanced this inefficiency of the order block, now continued in a downward movement. Now, let's go to the next one. Now, you look at mitigation block. The mitigation block is a breaker block with a failure swing. What is a failure swing? Now, look at this illustration here. The market is in an uptrend. As long as it's making a higher high and a higher low, the market tends to be in an uptrend, okay? Now, look at it. Now, the swing is higher high, higher high, higher high, lower high, lower high. That is the swing. Now, once there is a failure in the swing, it means that instead of making a higher high, now the market will start making a higher low. Then there is a failure in the swing. Now, look at it now. There is an order block here that is expected to keep pushing the market in an uptrend. Now, once the order block is broken, are you there? Now, automatically, a breaker block is formed. Now, once the swing fails to continue in the higher high, it becomes a mitigation block. Now, you look at the chart here, you discover that this is a higher high. This has been an uptrend, okay? This is the high, a higher high. The market has been making a higher high, okay? Now, it is expected, this is the other block here. Now, it is expected, now the market has respected the other block. It is expected for this market to break above this liquidity here, to sweep this liquidity to give us break of structure, okay? Now, but if you look at it in this case, the market fails to break and sweep this liquidity and the market start coming down, okay? Now, at the end, the order block at this point could no longer hold this market to push it back, but it broke through the order block. Now, looking at this scenario, number one, the order block has been broken and the market could no longer break or sweep the last liquidity. Now, this makes it a perfect mitigation block. Number one, a breaker block has been formed and a failure swing has also been formed. And what do we expect here? A reversal in price movement. Why? Because the market will come down to retest this other block that could not push the market upward. Once it retests the other block, it has balanced the inefficiency, and the next thing we should be expecting is a downward movement from that place. Now let's go over to the next one. Now we have inversion fair value gap. Inversion fair value gap. What is inversion fair value gap? Inversion fair value gap is a failed fair value gap. Now, in a nutshell, when a fair value gap fails to hold the price to continue in a trend it has been moving, is an inversion fair value gap. Now, if you look at the chart here, you notice that this market has been in a downtrend. Okay, has been what? In a downtrend. In a downtrend. Now, all of a sudden, a fair value gap has been created here. Okay, now what is expected? It's expected that this fair value gap should still push this market down to continue in this current downtrend. But look at it, this candle here broke the fair value gap. The fair value gap could no longer hold this market in a downtrend. Now this is what happened. The market came up, now came down again to balance this inefficiency before moving away in the new direction. So when a fair value gap fails to hold the market in the current market trend, an inversion fair value gap has taken place, and it gives you a signal of a reversal in the price movement. Now let's look at the next one, the Reaper inversion fair value gap. Okay, now what is Reaper inversion fair value gap? Now the Reaper inversion fair value gap is a failed inversion fair value gap. Remember, that fair value gap being broken gives us inversion fair value gap. So we are expecting a reversal in price movement. Now, but when the market breaks the inversion fair value gap and continue back in the original trend of the market, a Reaper inversion fair value gap has occurred. Now let's look at it here. You notice that this market has been in an uptrend, okay, making higher high, making higher high. Now there is a fair value gap here expected to push the market in an uptrend. Okay, now it respected the fair value gap now, but could not push it up. You can see the fair value gap was broken here. The fact that the fair value gap was broken, we should be expecting a reversal in the price movement, which is a downward movement. Okay, now look at it here. It tested it, balanced the inefficiency, and moved down a little bit. Then if the market had continued in a downward movement, then inversion fair value gap has taken place. But look at this scenario now. Now this is the inversion fair value gap that we are waiting for. Now instead of the market to continue to give us a complete inversion fair value gap, the market was broken again. So once an inversion fair value gap is broken, it gives us a Reaper inversion fair value gap. And what does a Reaper inversion fair value gap do? It continues the trend in the market original direction. Now you look at this, you notice that now this market has been in an uptrend. Now this is a break of structure here, another break of structure here, break of structure. Okay, now this is a fair value gap here. This is candle 1, candle 2, and candle 3. Now this is a gap between the candles, the fair value gap. See this gap and see this gap. Okay, this is a fair value gap. Now it is expected that this gap should be able to hold the market, okay, upward again to continue in its trend. But look at it, it was broken at this point. Now because it was broken, now normally the inverse fair value gap has taken place. So it is expected that the market, after testing or balancing this inefficiency, will start coming down. But look at it, it came down a little bit to give the retail traders hope that yes, you did the right thing. And all of a sudden, it broke the inverse fair value gap again. Are you getting it now? It broke the inverse fair value gap again, mitigated it, and continued in this upward movement that the market was before. Now, let's go to the next one. Now, I want you to look at this. These are the volume imbalances we have in the market. Now, the fair value gap is one of the volume imbalance. Then we have another one, the volume imbalance. Now, this one occurs between two candles, okay? Normally, a candle is supposed to open like this. This is the close. Now, if another one is supposed to open, another one will start exactly from the close of the previous candle, okay, to start. Now, but you see, there is no gap here. The closing and the opening of the same candle is supposed to be at the same level. Are you there? Now, but once there is a gap between the closing of the previous candle and the opening of the next candle, an imbalance has been formed. And the market must come back to mitigate that imbalance. Now, look at another one here. The same thing similar. Now, this is a gap entirely. Once there is a gap between the previous candle and the current candle, now an imbalance has been created, and the market must come back to mitigate or balance the inefficiency before moving to the next. So whenever you open your trade and you see a gap like this created in the market, now know that the market must come back to mitigate this gap, to balance this inefficiency before moving away to the next direction. Now let's look at the chart and see how this volume imbalances plays out in the charts. Now you look at this market, you notice, look at this, you will see that there is a gap here. This is a total gap between the two candles. There's a gap between the two candles. Now what did the market do? You see, the market has been, after the gap, the market was in a downtrend, but the market came up here to do what? To mitigate this, to balance the inefficiencies created by this gap. Now the market came down, balanced the inefficiency, and moved down. Are you getting it? Now look at the second one. You can see this is the opening, this is the previous candle, and this is the current candle. You see that the close of the previous candle and the opening of this new candle, a gap was created. Look at it. The market came down, came up again, mitigate this, balance the inefficiency, and continued. Okay? Now look at the same thing again here. A previous candle closed. Now this is a opening of the next candle. You see a gap was created. You see the market moved down, came up again, mitigated the gap. Are you there? Now, and continued. Look at another one again. You see another gap again. You see another gap occurred here again. Okay? Now the market moved up, came down with this candle, mitigated it, and it's moved. So as long as there is an imbalance created in the market will always come back to balance that inefficiency before moving in the next direction. I believe that you have learned something from this video. But before you go, don't forget to hit the subscription button, like this video, share the video so that it will benefit another person. But above all, don't forget to turn on the notification bell so that when I send the next video, you'll be notified.